Larry, so good to see you. Today we are talking through 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of uncertainty and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio right now. And I'd like to start with this chart. What stands out to you about how the market responds to global events?
Yeah, Aaron, for the most part, the market's very resilient. I mean, when things happen, the media talks about it. A lot of times you're going to have some short-term losses. But if you look at the long term, the market's always very resilient and pops back most of the time super, it actually has some great growth on it. Maybe the short term during the 10 years, 2000, 2010, the dot-com bubble, the lost decade. But even that, it certainly was a good time for investing that it grew over the long haul. So it's always just a short-term loss.
hmm It's easy to see when you zoom out that staying the course, staying invested is often the best advice. But if I feel uneasy about how I'm invested, when is the right time to make changes to my portfolio?
Yeah, look, anytime you can't sleep at night, you should be making some changes. But
Yeah.
for the most part, talk to an advisor before you do that because, as we mentioned many times, when you have that short-term volatility and the market's down, that's the worst time to sell and move into something else. Now, if you have a longer time horizon before your retirement, it's the best time to actually maybe make some actually purchases in there. So the main part there is know what stage of life you're in and make sure that you talk to someone to where you can create that strategy there and not have to worry when those things happen.
Right, because if you are nearing retirement or recently retired and the markets are down, that presents a unique risk known as sequence risk. Can you walk me through that, please?
Absolutely. Probably the one misunderstood item of all the retirees that
Yeah.
accumulating money, the sequence of returns matters not. As you can see these two charts, it matters not during accumulation. If you flip your rate of returns upside down over a long haul, they're going to be the same. However, when you start withdrawing monies from those investments, sequence of returns mean everything because as you see in this chart, one person has $105,000, but because of sequence of return, the other one has 35.
Wow.
That be a negative over like you run out of money before you run out of life. It's not a good thing.
Right. And of course, we have no control over what the market's doing when we retire. So how do we even guard against sequence risk?
I mentioned earlier, Aaron, that we need to make sure we have a plan, and when you're in that red zone of retirement, you're that closer that last 5 years, 10 years before retirement, create strategies that those kinds of media things, or I say media world events that happen that you're in control. So you see the three bucket strategies here, safety, income, growth. You got to have that growth bucket to beat inflation to make sure you don't run out of money as well. But those first two buckets, that safety bucket, having access to funds that if the markets are down are not going to affect your income for a 3 to 5 year period, and the income bucket in the middle are critical to set down, and that's going to prevent that sequence of return risk. So having a plan in place is just very, very important for you, especially when you get in that red zone.
Absolutely. Well, Larry, if somebody is either feeling uneasy about how they're invested right now or wants to talk to you more about setting up that plan so that they can retire and guard against sequence risk, what's the best way to reach you?
Yeah, they could give us a call. It's 615-216-1048 or our website, sfawealth.com.
Great. Larry, again, thank you so much for your time today. I really appreciate it.
Thank you, Aaron.